Hey, this is Jim Musgrave, and welcome back to Retirement Insights. I have been on a roll the last few weeks talking about ways to help you minimize your taxes. We talked about different strategies and investments to reduce taxes. We talked about how qualified plans worked. In the last episode, we talked about required minimum distributions. So if you haven't seen those episodes, I highly recommend you do so. Today, I'm going to start a series on Roth conversions. Okay, this is a huge topic. I can't cover everything in one short episode, so I'm going to break it down. And I'm going to start with who should and who should not convert to a Roth IRA. Okay. Now, again, there's a number of things that you need to consider before converting to a Roth IRA. So let's just kind of talk about the functionality of what you're really doing. What you're doing is that all you're doing is taking a distribution from an IRA, you pay the tax, and the remaining amount of money goes into a Roth IRA. And, I use what we call the personal economic model and with my clients to kind of just illustrate concepts. But all we're doing is that we typically have a risk tank where all the investments are, and we're going to open up that valve. That money is going to come out and it's going to go through the tax filter. Then after it goes to the tax filter, it's going to go up and you've got a choice where that money is going to go. It's either going to go into the risk tank or the safe tank. Most of the time, it just goes back into the risk tank into a Roth IRA. And you invest that money any way you want to. But that's essentially what's going on. What I've talked about in previous episodes is that the key to doing a Roth conversion is when you do it, you got to check the box conversion that, on the form, they know that it's a conversion versus a distribution. So just remember that. But you can also, when you're doing a Roth conversion, the most common place to put that money is in a Roth IRA, but you could also put that money into cash value life insurance. And there's certainly advantages of doing that. Again, we'll do another podcast on cash value life insurance, but for the time being, we're going to talk about the Roth conversions and who it's really suitable for. Okay. Essentially, there's been some laws that have come out recently, and once the conversion is done, the taxes will be owed, and now you cannot recharacterize it. Okay. Once you do the Roth conversion, it's permanent. You cannot say, oh, never mind, I don't mean to do it. You used to be able to do that. You can't do that now. So who should convert to a Roth IRA? The number one reason why people do that is because they feel that their taxes are going to go up. And so especially people with higher income, they're really concerned that, hey, if taxes go up, I'm going to get hurt, much more than I'm being hurt right now with my normal tax rate. And that's the number one reason why people are converting is obviously is that taxes are kind of going up. And, I've talked about this before, is that when you look at our federal deficits, they're out of control. The latest stat I saw is that we've got $1.7 trillion going out in expenses versus coming into the Treasury. So obviously more money is going out than coming in, and government doesn't like to cut things back. It's really hard to do cuts of services, and tax cuts are only going to make the deficit grow even larger. And it's just a big mess. And this is one of the things that I talk about in my Tax Storm Masterclass, where we talk about legislative risk and tax risk. So anyway, the main thing is that we're in an environment where we have high deficits and just a huge appetite to get more tax revenue coming in. And you can just look it up over and over and over. All the credible people, economists, money managers, government people, they're all the same opinion that taxes are going to go up. And that's the main reason why people would do a Roth conversion. Okay. And so if we look at the tax history, historically speaking, we're at a fairly low period of income taxes. And the Tax Cuts and Jobs Act, which I'll talk about in just a second, is most likely going to sunset at the end of 2025. And what this is that, and this is where I have these conversations with clients, and they say, hey, I got $1 million in my 401k. I'm doing great. I'm going to be fine. I said, yeah, is all that money yours? No. Part of that is yours. Part of that is the government's in terms of the taxes that you pay. Remember, you never paid taxes on that money. Okay. So the taxes are historically at a low average. In fact, the average tax going back over the last century is over 56%. Okay. So when you're looking at the deficits that we have, and we're looking at historically, we're at low income tax rates, there's a lot of wiggle room for those rates to go up. So that's the main motivating factor for people to convert. Okay. So just to kind of show you right here now where the tax rates are, is that, and again, I covered this in a previous podcast, but let's say you are a couple married, filing jointly. And, you could be in a tax bracket now that's in 22%, and then very easily be in a 25 or 28% tax bracket. Okay. So the tax rates reverting back or sunsetting are real. And we also have the standard deductions that may change as well, and the personal exemptions. Okay. This is a huge threat to our wealth. Quite frankly, I'm just telling people you got to wake up. Okay. So again, taxes are most likely going to go up. You've got a choice. You can either ignore it and just wait for them to go up, or you can take proactive measures and do something about it. Hopefully you do the latter. Okay. Now, the other people who should convert would be the people who just don't need the money soon or at all, especially if those people who plan to pass their estate to their families and their beneficiaries. Okay, that definitely makes sense. And one of the things is that Roth conversions are a great estate planning vehicle, even more so with the Secure Act 2.0 that has kind of come out here. And so, again, people who don't necessarily need the money, it makes sense to do that. And not only are they doing the conversions for themselves, but they're also doing the conversions for their children and grandchildren. In the last episode of the RMDs, we talked about the 10-year rule. Okay. So just to let you, if you missed that episode, you're not familiar with the 10-year rule. Basically what that means is that if I have an IRA and you are my beneficiary, I die, you open an inherited IRA account, you have to withdraw 100% of the money that you inherited from me by December 31st of the 10-year anniversary that you got the account. So you got 10 years to fully take the money out, pay taxes on it. And if you're in the mindset that you want more of your estate to go and your family not to pay, or your beneficiaries not to pay the tax, then if you do a conversion, they're still subject to the 10-year rule, but they don't have to pay tax on that money for those 10 years. Now, when they pull the money out, they could put that money into a non-qualified or taxable account. They may have to pay capital gains at that, but at least the bulk of the money that they inherited from the Roth IRA can grow tax-free for 10 years. So it's a huge estate planning vehicle to do a Roth conversion. Now, who should convert? Number 3, anyone naming any IRA trust as an IRA or plan beneficiary. And just to give you some background on this, if you need to understand that trust income tax rates are completely different than people or human tax rates. Trust tax rates are much, much lower. The thresholds are much, much lower. So it doesn't take very much to be in the highest tax bracket for a trust. And so converting to a Roth IRA ultimately, eliminates the potential of that money being in a trust, assuming that the inherited Roth IRA is not in trust. But the bottom line is that when you convert to a Roth, you're not subject to those very high trust rates that you can do. Now, this is a topic that gets a little complex. You definitely want to talk to your estate attorney about this, but it's a big one. So if you know anybody who's got a trust as the beneficiary of an IRA or a Roth IRA, you really need to talk to your estate attorney and make sure that the trust is set up correctly. You may want to change the beneficiaries on the IRA. Okay, that's an important thing. All right. People who have certain tax characteristics. Now, this is another thing. If you're in a low tax bracket, you can offset these tax losses, deductions, and credits. So, for example, if you're in a 15% tax bracket, you shouldn't waste it. Okay. So, for example, let's say you are a business and you've got net operating losses. And what you can do is that you can actually offset the business losses, deductions, credits, all that kind of stuff of the business, and use the Roth conversion to actually convert to the Roth, which is a taxable event, but some of the losses of the business can offset that. Now, it's not going to offset the capital losses, but it can also offset some of the other deductions and credits, from the business. Again, this is another topic where you need to talk to your CPA about that. But there are some really interesting opportunities that business owners have to convert to Roths and to, especially if they have some, losses in the business. Okay. Another person who should convert, those who have money in non-IRA funds that pay the tax. Okay. Remember, when you're converting an IRA, all you're doing is taking a distribution and you got to pay the tax. Well, there's two different ways to pay the tax. You can either withhold federal and state taxes. So let's say you convert $10,000, and let's say you want to withhold 20% for federal and state. So instead of having that $10,000, you'd be getting roughly $8,000 because you're going to withhold 20% for taxes. So your $10,000 IRA now is turned into an $8,000 Roth IRA. That's one way to do it. It's not our preferred way to do it. Okay. Our preferred way to do it is to not withhold the taxes on the conversion and pay the taxes with monies outside of the IRA. Okay. So if you've got money in savings or even a non-qualified brokerage account or mutual fund or something like that, you're better off paying the taxes from non-qualified money than withholding the money from the IRAs and paying the taxes that way. Okay. So again, don't convert funds to pay the tax. This will generate not only, taxes, but it's even worse if you're under 59.5, that you'll incur a 10% penalty on that. Okay. So, again, you don't want to pay the tax for the conversions from withholding the money from the IRA if at all possible. Okay. Another type of person who should convert are young people. Young people tend to be in a lower tax bracket. Okay. And so Roth conversions tend to have low tax costs for younger people. And there is no 10% penalty to do a conversion. Let me repeat that. If you're under 59.5, there is no 10% penalty to convert an IRA to a Roth IRA. So it also may make sense to convert, money in old 401k plans at potentially lower tax brackets today, opposed to potentially higher tax brackets in the future. So there's some opportunities with young people. It's not just people in their 60s and above. Okay, so that's something that you ought to take into consideration as well. Okay, number 7, again, those who do not worry about paying the taxes later in retirement, or they don't want to worry about paying taxes later. Remember, RMDs cannot be converted to Roth IRAs. I covered that in my last episode. When you do required minimum distribution, you're either going to spend the money or you're going to save the money in a taxable account or potentially cash value life insurance. So another thing too is that you can do a Roth conversion when you're at the age of taking your required minimum distributions. So let's say, I'll make it up, you're 75 years old and you've got to take your RMD. Technically, the custodian that you work with is going to require you to take that RMD first, and you can do Roth conversions after you do your RMDs. But you can certainly do a Roth conversion even if you're the age of taking your required minimum distributions. So you can certainly do that. Okay. So who are the people who should not convert to Roth IRAs? Well, one is that, seniors who just quite frankly need the money. And, they just need the money for living expenses. It may not make sense for them to do a Roth. And other people, too, that just believe that they're going to be in a much lower tax bracket. Okay, that is a possibility. Okay, just think about it. I want you to kind of think about this concept for a second. If you want to maintain your standard of living while you're working in retirement, that's going to require you to spend roughly the same amount of money. Would you agree? Okay. Now, if you're in a super high tax bracket, 35, 37%, then it's conceivable that when you retire, you are going to be in a lower tax bracket, right? Now, that's if the tax brackets stay the same. Well, what if taxes go up? So that's what I'm kind of betting on, right? I mean, I'm in a higher tax bracket, but I don't want to take the risk that, even if my income drops in retirement, taxes still may go up beyond, where they are right now. So it's just a risk, right? It's like, like going to Vegas. It's like, you're gambling. But I'm taking the bet that the taxes are going to go up. So I'm contributing to my Roth IRA. And, I'm just, I'm trying to take it into the mindset that I most likely won't be in a lower tax bracket, but you might. Okay. It's just something to take into consideration. If you want to take that gamble of the risk that taxes are going to stay the same and not go up, then, that's your prerogative. Okay. Now, I also run across this too, is that, people shouldn't convert. It's just like, I just can't write that check to the IRS, man. It's just too large. I don't trust the government. The government may change the rules. They may. But, if you can't bring yourself to write the check to pay the taxes on the conversion, don't do it. It's not worth the mental anguish. Okay. Other people who should not convert, those who do not have non-retirement money available to pay the tax due on the conversion. We just kind of mentioned that. Okay. Anyone who asks how soon they can take the money out. If they're going to need the money immediately, don't convert to a Roth IRA. Here we're starting to kind of get into another topic of the 5-year rule. I'm going to cover that in the next episode. But there are some rules in terms of having access to your Roth IRA account when you do those conversions. Okay, so we're going to go over that in detail in an upcoming episode here. Okay, but if you want to convert and say how soon can I get the money, then I wouldn't do it. Okay. Just go ahead and take that distribution out of your IRA and, kind of take that money and have fun. Okay. Now, the other thing is that people who should not convert is that those who have a charity named as an IRA beneficiary. Okay. Again, the charity will not have to pay the income tax when they inherit the IRA. So why should you want to pay the income tax on the Roth conversion? Okay. We talked about in the RMD podcast, the last one we just did, about QCDs, qualified charitable distributions. Okay. That's one way to reduce your required minimum distribution, is to actually make a charitable gift to a charity. And you can do that once you reach age 70 and a half, and you can do up to $100,000. So the point is that it doesn't make any sense at all to have a charity be the beneficiary on a Roth. You want to have that to be on your qualified accounts. Okay, so that's another thing too. Again, anyone who's not sure if they have the funds to pay the tax due on the Roth conversion, again, they can. The conversion can no longer be undone. So we kind of go back to that. And one of the ideas I have for an upcoming episode is that one of the a really interesting way to actually pay taxes on Roth conversions is through the equity in your own home, through a reverse mortgage line of credit. Okay, I'm just going to tease you with that thought, but that's that's a tool in the toolbox that very few people know about, and so we'll kind of share a little bit more about that in an upcoming episode. And then finally, the people who should not convert is anyone receiving financial aid based on the income may not want to, an income spike in those years. They may want to avoid the Roth conversion that could disqualify them. And I'm actually going to add another one too, is that just kind of keep in mind that when you do a Roth conversion, your income goes up. And so the IRMA threshold, which is the amount that you pay on your Medicare, premiums, could also be affected. So those are just things that you need to take into consideration. So the main thing is that, there's pros and cons of converting. And the main thing I could tell you is that the first thing you need to do is understand what your tax bill is. And if you go to my website, jimmusgrave.com, I've got right on the homepage this lovely couple. And, if you click on that, it'll take you to this page right here, which is your potential tax bill calculator. And if you're married, you want to kind of do this separately, but basically you type in your current age and the sum amount of all your qualified plans, your 401ks, your IRAs, all your pre-tax dollars, add all those accounts up, plug them in there. And then you also plug in, well, what's your estimated tax rate when you pull the money out? And then just put in your basic information right there. And that report will be emailed you immediately. And it's going to show you the difference between there's a required amount of taxes that you have to pay, and then there's an optional. And what I can tell you is that if you continue to go down the path and you don't do conversions, that IRA is going to continue to grow, and so are the taxes. Okay, it just balloons. And so one of the first steps to determine does it make sense to convert is to actually have a report run. And this is something you could do right on my website. There's free. There's no obligation to do any work together or anything. So again, I just put this out there for anyone to take advantage of. So again, if you like what you're talking about, if you like this episode, then you can go to my website, jimmusgrave.com. And I go to the podcast page and say, hey, listen, I'd like to request the handouts, for this episode or any other episodes. And the other thing too is that if you get on our email list, is that all the people on my email list, all my clients and people who we've kind of built this over time, they actually get emails with the handouts for future podcasts. And so, that's a truly valuable thing. So we're trying to kind of build this community. I'd like to, if you'd like for me to get this stuff out to you, I'm happy to do it. But that's one advantage of being on the email list is that you get all this content for free. Just take it. Again, I look at these little episodes as mini master classes. All right. So again, if you like what you see, go ahead and hit subscribe to the YouTube channel and look me up on Facebook. Again, just if you look up James C. Musgrave, CRPC, that's me. That's my business Facebook page where I also put a lot of this content. I put stuff on the Facebook page that I don't necessarily cover in the podcast. So, please, join my Facebook page and kind of, like us there. And hopefully this was helpful to you. We're going to be doing more, episodes on Roth conversions. So definitely stay tuned to that. But hopefully this was helpful. And we'll see you next time on my podcast, The Retirement Insights with Jim Musgrave. Okay, take care now.